Hedge funds are investment vehicles that pool capital from accredited or institutional investors and employ various investment strategies to generate returns. They are typically managed by professional fund managers and operate with a more flexible and opportunistic approach compared to traditional investment funds. Let's delve into the introduction, strategies, risks, and regulations associated with hedge funds. Hedge funds aim to achieve positive returns by actively managing a diverse range of investments. They often target absolute returns, aiming to generate profits regardless of the direction of the broader market. Hedge funds can invest in a variety of asset classes, including stocks, bonds, commodities, derivatives, and currencies. These funds often have more flexibility in their investment approaches, allowing them to employ both traditional and alternative investment strategies. Strategies. Hedge funds employ a wide range of investment strategies to achieve their objectives. Here are some common strategies. Long-short equity. Hedge funds take long positions in securities they expect to appreciate and short positions in securities they believe will decline. Global macro. These funds focus on macroeconomic trends and events to make investment decisions across different asset classes and markets globally. Event-driven funds invest based on specific corporate events, such as mergers, acquisitions, restructurings, or bankruptcies, aiming to profit from price discrepancies resulting from these events. Arbitrage. Hedge funds engage in various forms of arbitrage, including merger arbitrage, convertible arbitrage, or statistical arbitrage, aiming to profit from pricing inefficiencies between related securities or markets. Risks. While hedge funds offer potential for attractive returns, they also involve certain risks that investors should be aware of. Market risk. Hedge funds are exposed to market volatility. Adverse market conditions can negatively impact the fund's investments and overall performance. Leverage risk. Hedge funds often use leverage, borrowing money to amplify their investment positions. While leverage can enhance returns, it also increases the potential for losses if investments perform poorly. Liquidity risk. Certain hedge fund strategies involve investments in illiquid assets, such as private equity or distressed securities. This can pose challenges if investors seek to redeem their investments during periods of market stress when selling such assets may be difficult. Counterparty risk. Hedge funds enter into transactions with counterparties such as prime brokers or financial institutions. If a counterparty fails to fulfill its obligations, it can impact the fund's performance and financial stability. Operational risk. Hedge funds face operational risks, including errors in valuation, trade execution, and inadequate risk management systems. Operational failures can lead to financial losses or reputational damage. Regulation. Hedge funds are subject to regulations that vary across jurisdictions. Here are some key regulatory aspects. Securities laws. Hedge funds must comply with securities laws and regulations governing their operations, including registration requirements, reporting obligations, and restrictions on marketing and solicitation. Investor accreditation. Many countries impose minimum income or net worth requirements on hedge fund investors to ensure they have the financial means to understand and withstand the risks associated with these investments. Anti-money laundering, AML, and Know Your Customer, KYC. Hedge funds are subject to AML and KYC regulations to prevent money laundering, terrorist financing, and other illicit activities. These regulations require thorough due diligence on investors and reporting of suspicious activities. Regulatory reporting. Hedge funds may be required to report information about their operations, positions, and risks to regulatory authorities. This promotes market transparency and enables regulators to monitor systemic risks. Risk management and compliance. Hedge funds are expected to establish robust risk management frameworks and comply with regulatory requirements. It's important to note that specific regulations can vary by jurisdiction and may be subject to change.